My last real question for you is: you talk about starting tomorrow, starting today.
Mm-hmm.
I remember when I first put just $300. I had a bonus check from work. I put $300 into Robinhood. Bought a bunch of stuff. It's not important what I bought, but it wasn't until late 2020 that after 3, 4 years, I finally made money instead of seeing my money go down.
Mm-hmm.
I would say it's because I switched around a couple of my stocks. I sold a few that had been chronically underperforming in order to get some that I had my eye on. A couple of early investments, early buy-ins, they finally started pulling a profit. But generally speaking, how long until somebody gets an appreciable return on their investment? Say even I got a 10% return and it took me 4 years. About how long should you say somebody should expect to wait? And if they're not seeing gains, at that point, reevaluate. What would you say?
So depending on how you're investing, that will determine it. But I'm going to just go from a general. You're investing in the S&P 500 or an index that tracks that. The stock market will typically go up 3 out of every 4 years, which means depending on when you started investing, you might have it go down before it goes up. And that's okay. If you invested $300 in 2008 in January, when you got to the end of 2008, you didn't have $300. And it took you a long time to get back to that, a couple of years. So the general framework that I'm going to work from, especially as a younger person, but really even anybody, somebody who's into their 60s, you're still invested for probably, you're going to have a different mindset at age 60, but you're still looking at hopefully 20 years at least. And so knowing that, and that the stock market over time is going to typically go up, you want to have a 5, 10, and even 20 to 30 year outlook. So I would say you can't predict this, but at 5 years, if you're not making money, there's probably something. If the stock market is doing really poorly, okay, that's fine. But there's something that you're doing that's off, and you want to adjust and figure out, how can I do this differently? I'm speaking from experience because I didn't start investing in 2020. I started investing in 2017, and I didn't make a single dollar. I only lost money from 2017 to the very end of 2019 when I started investing on my own. And I found that to be very fishy. I thought that was very strange. Thought, I'm going to get started. We have some money available. Let's do this. I'm excited. Hired somebody to help us get started, and 2 different financial advisors through two different plans. And it was a gloriously disappointing experience because I lost money. And then I looked at the S&P 500 over those years, and from 2017 to 2019 was fantastic. There's no reason I should have lost money, but it was the structure of the funds that money was in caused me to lose money. I was so frustrated and so upset, but once I actually learned about investing, I went back and I figured out what was my return to the date perfectly between what I had invested in compared to the S&P 500. And I was very disappointed to find out that I had like a negative 50 or negative 48 in one fund and a negative 40% return compared to the S&P 500. I lost out on not huge chunks of money, but that's a horrible return. And I'm telling you, there are ETFs that would have at least, at the bare minimum, guaranteed that would have matched the S&P 500. So over that 2, almost 3 year term, there's 0% of reason I should have not made money. But because of the funds that I was in, that as the financial advisors had taught me to be in, that's what happened. So understanding that there are ways, there is no reason you shouldn't match indexes on returns. And the financial community doesn't want you to know that. A little known fact, well, little known fact by people who don't really understand the investing world is that 80% of mutual funds do worse than the market. At the same time, stock pickers, individual stock pickers as I am, will be right essentially 4 out of 10 times. That's better odds. That's better odds than picking the right mutual fund. If 80% underperform, 4 out of 10 will outperform the S&P 500.
60% chance of 40% chance of doing well as opposed to 20%.
Exactly. Yep. And
if you're diverse enough, those numbers end up like averaging out.
Yep. Exactly.
For a grain.
Yep. So really what I want to be able to show, you can do this on your own, and there is a bare minimum that you can do that can guarantee that you will match the stock market's returns, the overall general stock market, and without hiring anybody. And that is not something the financial community really wants you to know, because that means they don't need to have a job. And there are some great companies that have really built this to allow people like you and me to do that very easily. There are ways to beat the market. A lot of people will say you can't. There's a lot of research out there saying that over the long term, nobody beats the market. But I can tell you, working with the Motley Fool, they're going to explain to you very clearly how they do it and why they can beat the market. And one of the biggest reasons is most money managers, when they are working with a large fund, they are buying and selling stocks. I mentioned you have never sold a stock, and I don't plan to sell one until at least 5 years, because that's what they recommend. They rarely recommend to sell stocks. They look for great companies and they hold them through the ups and the downs. It goes down 50%. Who cares? 5 years from now, that might go up 100%. You got all your money back and could keep going. I'll give you a great example. Tesla, people have known about Tesla for a long time. From 2012 to 2019, Tesla essentially stayed flat. Had some ups and downs. 2020 hit. Tesla went from below $100 a share to now it's over $900 a share, or around that at this time, in a year. So if you held that through that whole time, you're going, man, Tesla's a horrible investment. Until, now EVs are becoming a thing. People are really excited about it. This could completely change the automobile industry forever. And what happens to their stock? Goes like that. How would you feel if you sold that in 2015, looking at it now? So when you buy good businesses like that on an individual stock level, it can take 5 to 10 years for a company to really execute on their business plan. They have to give quarterly reports. A lot of day traders and a lot of even individual investors fall into the, they had a bad earnings report, I'm going to sell because it was high now. A lot of companies, they're not, if they're a good company, they're not thinking about 3 months from now. They're thinking about 3 years or even 3 decades. Where are we going to be when we are the next Amazon? And we're dominating the industry. Amazon nobody knew about Amazon 20 years ago. Now it's the largest company in the world. Nobody knew at all, but they were selling books. And everybody was like, they're not going to take out Barnes & Noble. Guess what? Now they own...
They own Barnes & Noble.
Practically, but they don't. But they can do so much within their ecosystem, and they're continuing to grow, and there's continuing to be a fairly good investment. There's really no reason to feel like you shouldn't be able to get returns over the long term. You just have to be patient, and if you're seeing over a 3 to 5 year time span that things aren't working, you might need to switch things up. Which brings me to another piece, is you really want to be tracking whatever you're doing against some index. Generally, that's the S&P 500. If I would have done that in 2017, by 2018, I would have gone, wow, this just is not a good fund. I should probably learn about this and figure out what's wrong. And I would have saved a lot of money and, of course, made a lot more money because of that. But I'm glad I went through that, because it forced me to go, what's going on here?
All right. So even though it may take a while to see a return, if you don't see a return after some years, that might not mean anything. It might mean a lot.
Mm-hmm.
So stay informed with the stocks you have and
Yep.
compare to another index.
And to add to that, because of the power of compounding, during the first 5 to 10 years, which I know that sounds like a long time, but you gotta have that mindset of, I'm gonna use this money to retire, I'm gonna use this money for a house, or whatever it is. Over that first 5 to 10 years, you're gonna go, I'm putting more money in here on a monthly basis, whatever you're able to manage, even if it's only $50 a month, you're doing something. Again, time is gonna bring returns faster than anything. But over that first amount of years, because of the way compounding works, you're not really making money off of your returns yet. But there becomes a point when you actually start making more money than you're investing. And that's a beautiful thing, because now you're making money on money that you made investing, rather than just making money off of money that you invested. And that's the power of compounding. So when you see graphs of this, it's like, oh, you're going, and it goes through the roof.
And suddenly you're gone.
And it's really incredible, the difference between 5 years and 10 years. You go, oh, it'll just double. No, it'll like triple because of the power of compounding. You go from 10 to 20 years, it balloons from there. And which is why people like Warren Buffett will say things, what was the one mistake you made as an investor? Warren Buffett's one of the richest men and one of the most prolific investors of our time. He said, if I would have done one thing different, is I would have started investing 1 year earlier, because then I would be 10% richer. Most of the money that Warren Buffett made, he's made in the last 20 years. What made him from a very rich man to an extraordinary rich man is that time where it was able to keep compounding and keep growing larger and larger and larger. So get started, get your feet wet, figure out how to navigate this, and over time, once you start to compound returns, small amounts of money can become incredibly large amounts of money. One last example, because this makes me really excited, is $1,000 in a company like Netflix. Whatever company that happens to be in the next 15 years that grows like Netflix has. They're not done growing. $1,000 in Netflix in 2005, people knew about them. They were sending DVDs out in the mail. You probably heard about them. You would have known and thought, oh, I could invest in that company. They're going to do something really great. That $1,000 is worth $250,000 now. And at any point along that road as they were growing, you could have invested in them and it would have been even more. So people, you don't have to get in at the very, very beginning. You can start seeing what companies are rising to the top. But a small investment can become a very large amount of money and a lot of worth, which is why the Motley Fool works so well. They're looking for those great companies, and all you need is a couple. And you get those couple, and it's going to take a small amount of money, and it's going to go whoop, and it's going to be a huge amount of money. And they kind of guide you through how that works and why that can create amazing wealth that can change your life. That sounded like an ad, but I really strongly believe in what they're teaching me through their services, and strongly recommend them. If you want to go beyond just an ETF, and get into stock picking, it's a little bit more work, but with that little extra work, you can make substantial amount of returns, potentially.
It sounds like you're on the cusp edge of a game changer, and looking forward to following you through that path and just seeing what happens.